All right. Well, let's get to investing. You gleaned some great information from
Yeah.
the Berkshire Hathaway, Warren Buffett's 2022 annual shareholder letter. He explains how a dozen or so investments over about 58 years have really generated the vast majority of his success. And I think it's an excellent point. We try to hammer on this point in our seminars all the time. It's great to see somebody like Warren Buffett pointing that out, because I don't think it is pointed out enough on how like you need the success in your portfolio in those individual companies to drive your overall returns. And he's coming out and saying this is the way to generate a portfolio that beats the market long term. And you have to have those winners.
Yeah, absolutely. Absolutely. So why don't we go through it? Because I thought it was a really interesting quote. And obviously, Warren Buffett is a man who needs no introduction. He's thought by many to be one of, or potentially the greatest investor of all time. And there's some people that will dispute that and they'll say, oh, he's not really that great, and they'll make some different points. But first of all, why do many consider him to be the greatest? Well, it really comes down to investment returns. So if you look at the return of Berkshire Hathaway from 1964 to 2022, it's 3.7 million percent. I mean, that's insane compared to the S&P 500 dividends included of just under 25,000%. So over this period of time, Warren averaged a return of just under 20%, 19.8% compounded annually compared to the S&P 500, which averaged 9.9%. Now, when people look at that return, 20%, if you know anything about investing in the stock market, 20% is a pretty good return compared to some of the numbers that the S&P has been posting over the past couple of years, last year notwithstanding. 20% to some people, it's like, it doesn't really look that impressive, but this is consistent over a period of 58 years. So this is that 3.7 million percent return. That is from 1964 to 1922. So 58 years is what we're looking at, right? Well, we're all about a long-term time horizon. Few have the stomach for that type of a time horizon. But we also don't need to build up $100 billion wealth like Warren Buffett as well. So anyways, on to the quote. Just to give some background, every year, one of the things that Berkshire Hathaway and Warren Buffett does is they publish the Berkshire Hathaway shareholder letter. And if you go to the website, berkshirehathaway.com, you can get these letters going back all the way to 1977, potentially even before that. And what this is for many, this is like a gospel in the investment industry. So like many shareholder letters, it overviews Berkshire's performance and operations over the previous year or years. But what it also does is it provides Warren Buffett's specific commentary on like investment ideas that he's had, things that he's done that have worked well, why he's done them, things that haven't worked out, and just lessons learned of what's going on in the market. So it's read by countless thousands of investors, and many consider it to be one of the best instructional documents out there on just intelligent investing principles. And many look at it almost like a textbook. There's some who say that if you are in the investment industry, you should go back, you should read every one of his annual reports. So this is something that we take a look at his annual report. It's not very long. They're fairly easy to read. One thing that Buffett really likes to do is speak in simple language. He doesn't like to make things very complicated. But there was one point that he made in this particular letter that I thought was really important to talk about, and it kind of surprised me just the way that he talked about his success. I mean, everybody wants to know, what is it that has driven Warren Buffett's success? What does he look at when he's analyzing a company, or how does he make investment decisions? So in the letter, he said, and this is specific, he said, in the 58 years of his managing Berkshire, that most of his capital allocation decisions, so his investment decisions, have really been so-so. So the majority of them have really not been that great. In a lot of cases, he's made some very bad decisions. But he said that the results that he has generated, these incredibly strong results over time, were really the product of about a dozen or so truly good decisions. So if you look at that, a dozen or so truly good decisions over a period of 58 years, that averages to about one good investment decision every 5 years, or one great investment decision every 5 years. So I thought that was really interesting, because people, when they think of Warren Buffett, they think, well, if Warren Buffett is buying this company, it must be good, right? But then the majority of the investments he makes, according to him, are not necessarily that great. There's a small number of very strong winners. And then he went on to actually talk about a couple of those winners. He called this section the secret sauce. And the first one that he talked about was Coca-Cola. So he mentioned that he concluded building his position in Coca-Cola in 1994. It was over a 7-year period that he built that position up. And the total cost was about $1.3 billion, which at the time was an extremely meaningful sum for Berkshire Hathaway. Now, Coca-Cola has been one of his top performers, and this is one of the dozen or so companies that have driven the returns. Now, how has Coca-Cola driven those returns? Well, one thing that he specified here was the cash dividend. So he mentioned that the cash dividend that he received, that Berkshire received from Coca-Cola in 1994 when they completed their purchases, was about $75 million. In 2022, that cash dividend has increased to $704 million, right? So 75 million to $704 million. Now, of course, what is this over? This is over a 28-year period. Again, we're talking long-term time horizons, but that's pretty considerable growth in dividends. So growth occurred every year in the dividend, and all they were required to do once they bought the company was just cash those checks. And that's what he liked about the company. That is one of the things that has driven that extremely strong return. Another of the major success stories that he talked about was American Express. So he had mentioned that in 1995 is when he completed his purchase of his position, multi-year purchase. It also cost $1.3 billion. That was the investment. And then annual dividends received have since grown from $41 million to $302 million. So again, they're increasing their dividends on an ongoing basis. Now, if you actually look over this time horizon of what the growth in dividends are, it's on an annual basis. It's not necessarily that spectacular, but it's the compounded growth over time that have really produced this performance. He mentioned that at year end in 2022, his position in Coke was valued at $25 billion, and Amex was valued at $22 billion, again up from $1.3 billion. So he's cashing those dividend checks, and then success in the business, including the growing dividend, has increased the value of the investment as well. So right now he's saying that each of these holdings now accounts for roughly 5% of Berkshire's net worth, compared to a much lower percentage when he initially invested in them. So really what the point that he's trying to make here is that there's two things going on. Well, there's a couple things going on. One, a point that we've made in the past, is that investing in companies that provide dividends and then also grow those dividends over time, growing the dividend because they're growing their earnings per share, is a key ingredient to investing success. So we've shown a lot of data in the past about how dividend growth stocks have vastly outperformed non-dividend paying companies and the market average on a total return basis. So with your dividends and your share price appreciation, growing dividends generally tend to, when it's sustainable growth, they generally tend to over time result in share price appreciation. But another point that he's making here is that when you invest in these big winners and you hold them over long periods of time, they completely overwhelm your poor investment decisions. So just as an example, he's doing the comparison where, say he had made an investment in 1994, 1995, around the time that he finished his other investments, of again $1.3 billion, same amount that he invested in Coke, same at Amex, and that investment went nowhere. Say it was a poor investment, it generated a fairly minimal return, and was still worth $1.3 billion today, then that investment would be worth about 0.3% of Berkshire's net worth, compared to Coke and Amex, which are both worth now about 5% of Berkshire's net worth. So what he says here, the direct quote is that the weeds wither away in significance as the flowers bloom. The flowers being those great investments that you make, the weeds being the mediocre investments that you make. And then finally, he makes the point, and this is something that the point that he makes a lot, is that investing is really a lot about time. It's about not trading the markets. It's about holding stocks that are compounding growth over a long period of time. And he says, of course, it helps when you live well into your 90s. And he's been doing this for 58 years. So, he said in the past, probably the biggest driver of his success is that he's been doing this for so long. But I would say as well, not making the poor decision of trying to time the markets and sell out and second guessing himself. Rather, he has been, focusing on solid businesses that he would hold over a long-term time horizon. And if you look at Warren Buffett's historical performance, it's not all been great. I mean, there have been years where the performance has been lower than the market, years where it has been very poor. I think it was one point in the 70s when he had a negative 48% return in Berkshire. Last year the return was 4%. It was a very weak market, still beating out the S&P, which was down 19%. In the years before that, when the S&P was super hot, he was generally underperforming the S&P. But it's really about time, not trying to time the markets, but just time in the markets, and then just sticking with good, solid companies that are compounding their growth and paying dividends. So one thing that I wanted to do here is I'm really interested in seeing what Warren Buffett sees when he makes decisions. And as much literature as there is about Warren Buffett and his investment strategy from a high level, I find that there is a lack of information about the types of valuations that he likes to pay at the time that he's buying these companies. Warren Buffett is often seen as a value investor. And maybe that's because his mentor, Benjamin Graham, is known as the godfather of value investing. But I don't really see Warren Buffett as a value investor. I see him more as a growth at a reasonable price investor. He has said in the past, he would much rather buy a great company at a fair price than a bad company at a great price. Meaning, just because a company is cheap does not mean it's a good stock. So what I did is he highlighted Coca-Cola. Out of the 12 companies, he listed Coca-Cola first. So I wanted to go back and see what Warren Buffett was seeing when he made these purchases, which were from 1987 to 1994. So I went to the Internet Archives and I pulled up financial data on Coca-Cola to essentially see the type of financial performance, the type of numbers that Buffett would have been looking at. And I find it very interesting. I mean, there's some volatility in revenue growth, in earnings growth, but generally speaking, Coca-Cola produced strong, high single to mid double-digit growth, mid-teen double-digit growth in revenue over this period of time, and good growth in earnings per share. Also consistently growing their dividend on an annual basis as well. But the P ratio is something that really interested me. So rather than just look at like a lot of data in a table, what I did is I averaged this data over the period of time here, the 7 years. And over this period of time, the average revenue growth of the company was 11.2%. The average earnings per share growth was 17%. The average dividend growth was 14.8%. And the average price to earnings multiple was about 24 times. So what I find really interesting is just the multiple that he pays for stocks. What does Warren Buffett see as reasonable value? Now, when you look at Coca-Cola back then, as from a qualitative perspective, what you would see is a company that is consistently growing its revenue, consistently growing its earnings per share, consistently growing its dividend. A company that is a global brand, an absolute behemoth and leader in its market, and that was continuing to grow its market share over this period of time. But it was never what I would consider to be incredibly cheap. So the lowest multiple we see here based on year-end share price was 16 times. And that would have been around the time that Warren Buffett was originally taking his position in 87, 88. And then the multiple got as high as is 33 times by 1991, but on average 24 times. Now we don't know exactly the multiple that Warren Buffett was paying. Just because the multiple peaked out at about 33 times, more or less, doesn't mean he was necessarily buying shares. There could have been volatility through the year where he was purchasing more. But generally, you're looking at a company here that's trading over 20 times earnings. So this isn't what most would consider to be a classical value investment. You're not looking at a distressed company trading at 12 or 10 or 8 or 5 times earnings per share. What you're looking at is a very financially healthy company, strong market position, strong operations, strong brand, and growth that is trading at a valuation which is not excessively above the market average. He's likely was, for most of his purchase, paying around 20 times or slightly over 20 times. So I found that to be very interesting, and it's the way that we look at the market as well. Just because a company is trading at a cheap multiple does not mean that it's a cheap stock to buy as an investment. Most of the time, that cheap multiple is justified by poor financials and poor fundamentals and a higher level of risk. And it's really about good, intelligent investing is really about finding great companies, but then not overpaying for them. So a lot of times you can find a great business that has all the fundamentals that Coca-Cola did. Maybe it's trading at 40, 50 times earnings, 60 times earnings, or much higher, which could easily be the case in the software space. That's the case where you also have to consider no asset, regardless of how quality that asset is worth an infinite price. So it's about finding great companies, not overpaying for them. Obviously, everything else equal, you want that valuation to be as low as possible, but everything else is never equal, and usually you will have to pay up a little more to get a great company. Anyways, that sums that up, and I think that this blueprint can really be applied to many businesses today. I mean, when I look at these numbers, they're impressive, but they're certainly not unheard of in today's markets. Companies growing, consistently at a good pace. Companies paying great dividends. I mean, one stock that came to mind in our income research is Brookfield Infrastructure, which we originally recommended in 2011 at an effective price of around $14. And then since then, that company has paid out, upwards of $23 US just in income distributions, and the stock has increased by multiples. So this is just this is a company that we originally recommended about 12 years ago. We've put the buy recommendation out again about 26 times, but just compounded over time. That's essentially what happens when you buy a company that's paying a nice dividend, growing the business, reinvesting capital back into the business, and then continuing to grow the dividend. And then Ryan, I mean, you talk about, you have an entire segment in our DIY seminars about how 2 to 3 great stocks can completely change an investor's life.
Yeah, and sometimes it sounds like hyperbole, right? And I say that all the time. But Warren Buffett, again, we would largely consider the greatest investor of all time, is basically talking about that right here. And
Hmm.
the thing is, you don't hear about that from most advisors, that this is what is driving your returns. And we talk about why some portfolios are structured. Many portfolios are structured not even to take advantage of these. And yeah, I mean, I think you talked about, just to step back a sec, you talked about just looking for growth at a reasonable price, right? You're looking for, it doesn't have to be the cheapest stock out there. It doesn't have to, it's obviously not going to be the most expensive, but growth going forward. And you looked at, even when he was looking at that, in terms of the EPS growth, 17% over that period. That's a high rate of EPS growth consistently over that period. And, he's buying the growth, and he's buying it at a reasonable price if it's continuing to grow at that level. And yeah, I mean, that's what we would be looking for on a daily basis. And I mean, I have some thoughts on this from the segment Aaron talked about. We do this segment in many of our webinars where we talk about 2 to 3 stocks can be game changing for the portfolios of our clients. And it's a point, again, like I said, most advisors won't tell you about. In fact, because of the way they construct your portfolio and it's structured, you basically don't have a chance of benefiting from these type of game-changing investments in your portfolio. And I have a slide that we can put up right now. It's a 4 great keystone stocks. Essentially, it's Boyd, we recommended at $2.30. It's around the 215 range. That's 9,500%. Expel, $1.42, 64, 67 today, 4,000 plus percent. Hammond Power, $1.15. It's in the $36 range today, over 3,000%. Water Furnace, $1.15, bought out at $30.60. So those are the type of stocks kind of that Warren Buffett is talking about there, where you have that tremendous growth over a long period of time in your portfolio and it compounds. Again, we've had more than these 4 in our coverage over time that have had thousands of percent gains. Ceramic Protection, Janus Systems, for example. And Aaron was looking for what is Warren Buffett looking at. So what is the common theme with these stocks? Well, the stocks, the 4 I listed there, for example, what is the common theme when we found them? Well, first of all, fundamentally, all were growing and trading at what we would call reasonable valuations with good balance sheets. And they had excellent growth paths potentially ahead of them and have executed on that. I would say what's curious about these companies is on the initial recommendation, not a single Canadian brokerage, even boutique brokerage firms or analyst firms had any coverage on Expel, Hammond Power, or Water Furnace. Boyd had basically one analyst at the time covering the stock, and it was soon discontinued out of coverage. Why? Well, one could say these are smaller companies, so they're just not covered as much in the markets in Canada or the US. But to me, that's not really the story here. There are hundreds, if not thousands, in a year basis with all the banks out there and boutique brokerages, small cap companies, smaller companies that get covered. The real story here is they had strong balance sheets. They did not need capital from Bay Street for the most part. Boyd has accessed convertible debt at some points, but really basically on its own terms. So if you don't need capital from Wall Street or Bay Street, you don't make the money, so you're not covered. So these are 4 of the companies that I listed there of the best performing stocks over the past couple of decades on the entire TSX Venture. And they would have never made it into most Canadian portfolios because they don't get coverage. They're not recommended. The big banks are not making money off of them. They would have made a game-changing difference in your portfolio, but it looks to me like the big banks, that's not their concern. Now, identifying these game-changing companies is probably the most difficult part, but it is not the end of your journey. Investors need to hold a couple of these stocks, like we say, in your entire lifetime in your portfolio to make a true difference in your wealth. But your portfolio must be structured in a way to be able to take advantage of these gains. If you build your portfolio with the traditional model, you have 5 to 10 mutual funds, each owns 100 plus stocks. Maybe if your advisor is adventurous, you own 20, 25 stocks. I just saw a portfolio last week that was sent off to us from a new client. He had 25 stocks. He had a bond portfolio. He also had, 10 plus ETFs in there. Now, even if one of these stocks, say the 4 that I listed there, made it into your portfolio through some dumb luck over the past 15, 20 years, the likelihood, it's likely one of like 50 or 500 stocks through the ETFs that you own, and it'll compose far less than 1% of your overall portfolio. They can increase thousands of percent, which is good, but it's not going to generate the game-changing wealth in your portfolio that many of our clients or many investors generally are looking for. So your portfolio actually has to be well structured to take advantage of these type of companies. You got to identify them, which is the hardest part, but then they can't be one of 500 stocks you effectively hold. For us, we call the sweet spot owning 15 to 25 high quality growth at a reasonable price stocks. That is so one of these game-changing stocks that you find in your lifetime. If a couple of them you can have in your entire investing lifetime, that is so they can make a significant difference in your portfolio. So that's the structure. I love what Warren is saying there. I love how he's bringing that to the attention of more people in the markets, more investors, because we've been hammering on this point for years. And, it's something that we can provide. And it's something that you should really look at, every Canadian investor in your portfolio. Make the decision. Do you want to make returns that can beat the market? Well, structure your portfolio and try to find those companies. If you just want to perform at the market rate, there are different ways to do it, far less risk, way simpler. But if you're trying to beat the market, most investors who are listening to this podcast or who are in the market are trying to do that. You got to structure your portfolio effectively, but first and foremost, look for those great growth at a reasonable price investments and allow them to execute over years and years and decades, as Warren Buffett has. And not every investment will be extremely successful, but if you can pull 2 or 3 in your lifetime that do what those 4 companies I showed on that slide, or like a Coca-Cola or an Amex for Warren Buffett can do, it can truly change your wealth position in your portfolio.
Yeah. One thing that I'd like to add too is, Peter Lynch makes the quote essentially saying that most big bank analysts would rather recommend a large blue chip stock that hundreds or thousands of analysts are following and get a measly return than essentially put their neck out there with a potential unknown stock that no one else is looking at. Just because if
that's scary,
because if
so
that stock
do that,
does
right?
underperform, then their manager will not be too happy with them. But again, it's
also, you got to put in a ton
of
work to find that company
exactly.
too. So some don't want to do the work, some don't want to have their neck stuck out. It's a combination. It's easier to do it the way
if you're wrong when everybody else is wrong, it's easy to just be like, oh, we were all wrong.
Exactly.
Not a big deal,
Yeah.
right?
But you're not.
But if you're wrong, if you go against the grain, if you go against the crowd, then you're wrong, you lose your job, right? And so that's that groupthink mentality is definitely strong on Bay Street, Wall Street.
Awesome.
Yeah, it's huge.
Good segment, Aaron. That was awesome. Glad to have you back.
Appreciate that.
Yeah, that was awesome.
But I don't know if we're glad to have him back. The segment was okay. But that was good. It was good. All right. We're moving on. If you got any comments on that segment too, you can tell Aaron if you hated it or loved it. Keep those comments coming in on YouTube there, or if you want to post them on our, if you're listening to it in podcast form as well on iTunes.